Welcome to NJO Young, the show where we dig into the research, the reports, all the source material to give you the real story behind a stock.
And today we are definitely getting into a fascinating one. We're focusing on AGNC Investment Core, ticker symbol AGNC.
Right. And this is a company that, it really draws in a certain kind of investor, doesn't it? The one looking for that big, steady income.
Absolutely. The dividend is the headline.
So our mission today, really, is to give this thing a full, balanced look. We've got all this source material from up to November 19, 2025, and we need to stack up the good, the really strong financial signals against some of the very significant risks that are baked into its model.
It's a real study in contrast. So as of last week, November 14th, the stock was around $10.15. It's up a little over the last year, about 5%.
Which is fine, but that's not why people buy it.
No, not at all. The real reason the spotlight is that dividend yield. It's consistently hovering somewhere between 14 and, 16%.
That is an eye-watering number. And in this market, when something looks that good, it means we have to dig deeper. We really need to figure out what this company actually does, how it's making those huge payouts, and most importantly, where the cracks might be. Okay, so let's unpack this.
Right, so let's start with the absolute basics. What is AGNC? It's a REIT, a real estate investment trust. But, and this is the key thing, it's not the kind of REIT you might be thinking of.
Yeah, you hear REIT and you think, buildings, shopping malls, apartments.
Exactly. Brick and mortar. AGNC doesn't own any of that. It operates completely in the financial markets, dealing only in mortgage securities. It's a mortgage REIT or an mREIT.
And their model is incredibly focused. I mean, they're not spreading their bets around on different kinds of debt.
Not at all. The term you see everywhere is pure play agency REIT. This means its entire portfolio, and we're talking a huge portfolio, about $90.8 billion as of the third quarter.
Yeah.
99.2% of that is invested in one thing: agency mortgage-backed securities, agency MBS.
Okay, so that word, agency, that's the key, right? It's the foundation for their entire strategy. What does that government guarantee actually mean?
It means everything. It means the principal and the interest payments on these mortgage securities are guaranteed by U.S. government agencies like Ginnie Mae, or these government-sponsored enterprises, the GSEs like Fannie Mae and Freddie Mac.
So in simple terms, the government is basically backstopping these loans.
Precisely. And what that does is it virtually eliminates credit risk.
And just to be super clear for everyone, credit risk is basically the risk of people not paying back their mortgages.
That's it. So you, as an AGNC investor, don't really have to worry about the housing market crashing and homeowners defaulting left and right. That risk is taken off the table.
So if credit risk is gone, the risk has to go somewhere else. Where does that high-stakes game get played for AGNC?
It shifts 100% to interest rate risk. That's the whole game. Since these assets have very little credit risk, they also have pretty thin yields on their own. So to turn those thin yields into a 14–15% dividend, AGNC has to use one main tool:
leverage.
Extreme financial leverage.
This is the engine, right? The core of the mREIT model. It's where the huge reward meets the huge danger. So walk us through how that leverage machine actually works. You mentioned the repo market.
Right. So AGNC's income comes from what's called the net interest spread, or NIS. You can think of it like a giant, very sophisticated arbitrage play. They buy long-term assets, these agency MBS, that pay them a certain interest rate over many, many years.
Okay.
Then they take those high-quality government-backed assets and use them as collateral to borrow huge amounts of money on a very short-term basis. And they do that in the repurchase or repo market.
So they're borrowing short-term at a cheap rate, using that cash to buy assets that pay a slightly higher long-term rate, and then they just pocket the difference.
That's the entire business in a nutshell. The profit, that net interest spread, is that small difference. But, and here's the crucial part, they amplify that tiny sliver of profit using massive, massive leverage.
And the numbers here are they're staggering. We're seeing a debt-to-equity ratio, a D/E, of 6.24 recently. For the average person, what does a number that high actually mean?
Yeah, this is the part that I think a lot of people miss. A D/E of 6.24 is extreme. It means for every $1 of equity that shareholders like you put into the company, AGNC is borrowing more than $6 against it.
6 to 1.
This huge magnification is what creates that high dividend. The profits are spread across a tiny base of equity, but it is a terrifying double-edged sword. Because if interest rates move the wrong way, or the value of their $90 billion portfolio drops by even a tiny fraction.
Like 1%.
That loss gets magnified by over 6 times on the equity side, and that leads to violent swings in the stock price and the book value.
So you're not just investing in mortgages. You're making a huge leveraged bet on the direction of interest rates.
Yeah.
Understanding that is, I mean, it's everything before we can even look at what the market is doing right now.
Absolutely.
Okay, let's zoom out then, because this is where things get really, really interesting. Since AGNC has basically engineered credit risk out of its system, its entire fate is tied to what the Federal Reserve decides to do.
The macro environment is everything. I mean, they operate in the agency MBS market. This isn't some small niche. It's a $9.2 trillion asset class.
Wow.
Only U.S. Treasuries are bigger. It's incredibly liquid. $310 billion a day was the average trading volume last year.
But the last couple of years, I mean,
Yeah.
thinking back to 2022, 2023.
Yeah.
That was a brutal time for REITs because the Fed was hiking rates so aggressively.
Oh, it's a bloodbath. Historically, mREITs get crushed when rates rise quickly. If you think back to what we said about the repo market, when rates go up, their short-term borrowing costs, they just skyrocket.
Yeah.
And they go up much, much faster than the income they're getting from their long-term mortgages can adjust. And that just squeezes that net interest spread, sometimes down to nothing. It destroys profitability and book value.
Okay, so that's the history. The question is, are those headwinds still blowing, or are we finally seeing a change?
And that's the big story in the source material right now. We are finally seeing what the analysts are calling crucial tailwinds starting to emerge. The outlook is becoming much more bullish for the whole sector.
Okay.
Macroeconomic stability is getting better, inflation has cooled off quite a bit, and the consensus forecast for the Fed is pretty clear.
Rate cuts.
Rate cuts are coming.
And this isn't just a minor thing. This is the single most important catalyst for a company like AGNC. What are the forecasts actually saying?
The forecasts are for a pretty significant drop. The Fed funds rate could fall from where it is now, that 4.75 to 5% range, all the way down to maybe 2.75 to 3% by the end of 2026.
That's a huge shift.
It's a foundational shift for a company whose entire business is built on borrowing at the short end of the yield curve.
So just walk us through the mechanics one more time. Why exactly is the prospect of rate cuts such a powerful tailwind for a model this leveraged?
It's all about the cost side of their profit equation. A rate cut from the Fed almost instantly lowers AGNC's borrowing costs in that repo market.
Right, their expenses drop.
Their expenses plummet, and that immediately expands their net interest margin, their NIM. And remember that debt to equity of 6.24. When that spread widens, that high leverage amplifies the profits just as violently as it amplified the losses on the way up.
So the double-edged sword starts cutting in your favor.
Exactly. And on top of that, a better interest rate environment is expected to boost the value of their assets, their MBS portfolio, which should lead to a nice rebound in their book value.
Okay, so the macro story, the theory, it all sounds very positive.
Yeah.
But let's look at the hard numbers. Let's dig into their most recent earnings report, Q3 of 2025, and see if that optimism is actually showing up on paper.
And this is where the story gets really complicated, because the Q3 results, they contain both the best bullish arguments and the most worrying bearish ones. But yes, they definitely show signs of financial resilience.
Okay, so let's start with the good news, the undeniable positive. The total economic return for Q3 was massive. And for an mREIT, that's kind of the main report card, right?
It absolutely is. Total economic return is the key metric. It's the change in the company's book value, their tangible net book value, or TNBV, plus all the dividends they paid out during the quarter.
And the number was?
10.6%. A massive 10.6% total economic return in one quarter. And a lot of the analyst reports are citing this as one of their strongest quarterly performances since the rate hikes began back in 2023.
And that 10.6% is directly tied to the value of their main assets, the agency MBS, bouncing back.
Correct. The tangible net book value per share is the number to watch. It rose by 47 cents, or about 6%, to $8.28 in the third quarter. That's a really healthy sign that the worst of the asset depreciation from the rate hikes might be over.
As long as the Fed plays ball.
As long as the Fed plays ball.
And beyond the book value, the top-line numbers looked pretty solid, too. Income, liquidity.
Oh, yeah, the top line was strong. Q3 net income was $806 million, which beat revenue expectations. And for a company that relies on so much short-term debt, Liquidity is everything. They're holding about $6 billion in unencumbered cash and agency MBS.
Unencumbered meaning not pledged as collateral for their loans.
Exactly. It's their safety cushion. It's a critical buffer against any sudden market shocks or margin calls.
Okay, but a company this leveraged can't just hope for a stable market. Management has to be actively defending against rate swings. And the sources all highlight that AGNC's hedging strategy is, well, it's extremely aggressive.
It has to be. Their risk management is very sophisticated. As of the end of the first quarter, AGNC had a hedge position that covered 91% of its debt exposure.
91%, that's huge.
It's an enormous hedge. And it's fundamental to their survival. They are essentially buying insurance using things like interest rate swaps to protect their book value from a sudden, unexpected spike in interest rates.
So can you just explain that simply? How does a swap actually protect them if they're borrowing in the repo market?
So a simple interest rate swap lets them basically turn their floating rate repo debt into fixed rate debt. They agree to pay a counterparty a fixed rate, and in return, that counterparty pays them the floating rate.
Okay.
So if short-term rates suddenly jump up, yeah, they're paying more on their repo loans, but they're receiving more from the swap. The two cancel each other out, and it protects their net interest spread. A 91% hedge ratio is. That's a serious commitment to defense.
I also saw in the reports that they're making a strategic shift into higher coupon securities. What's that about?
That's about improving the quality and predictability of their income. By shifting into higher coupon agency MBS, they get better cash flow. These particular securities are also generally less sensitive to prepayment risk.
Which is the risk that everyone refinances their mortgage when rates fall.
Exactly. Which is a real risk in the environment we're heading into. So this move gives them a more stable, predictable income stream.
And then there's this other strategic move they made, launching new indices with ICE. At first glance, why would a mortgage REIT bother creating market benchmarks? It seems a little abstract.
It's actually very shrewd long-term play. It shows a lot of confidence in their own model. They worked with the Intercontinental Exchange to launch these new current coupon agency MBS indices.
Okay.
The goal here is basically transparency and influence. Most of the big, broad MBS indices don't really reflect the kind of active current coupon strategy that a company like AGNC uses. By creating their own, they're trying to establish their strategy as the market standard.
So they're not just playing the game, they're trying to write the rule book.
That's a great way to put it. It could eventually lead to new products like ETFs that track these indices, which would in turn create more demand for the very assets that AGNC holds.
So if you put it all together, the strong economic return, the solid liquidity, the aggressive hedging, it paints a very compelling picture. Which brings us back to the main reason anyone buys this stock, the dividend.
It is their siren song. They have an incredibly consistent record here, 12 cents a month, every month since April of 2020, which, at the current price, gives you that incredible yield of 14 to 16%.
And the general feeling from analysts is that the dividend is safe, at least for now.
The consensus seems to be, yes, it's safe, if the Fed delivers on those rate cuts. The belief is that the expanding margin will provide more than enough income to support the distributions, but, and this is a huge but,
Right.
that high yield comes with a massive operational caveat that was revealed in that same Q3 report.
Right. Let's get into that.
We've been praising that 10.6% total economic return, which is great. It shows asset values are recovering, but it forces us to ask a really fundamental question. Is that 14% dividend actually being paid for by the company's day-to-day operations?
And this is the giant red flag for anyone who considers themselves a pure income investor. The sources point to a really serious mismatch in the Q3 numbers.
They do. The metric that really measures the pure recurring cash flow from the business is called net spread and dollar roll income, or NII. In Q3 2025, AGNC's NII came in at 35 cents per share.
And the dividend they pay out each quarter is 36 cents. 12 cents a month. That's a miss.
It's a clear miss. The NII not only missed analyst estimates, but more importantly, it failed to cover the dividend. The coverage ratio was a worrying 0.97.
So let me get this straight. They paid out more in dividends than they actually earned from their core business of borrowing and lending.
That's exactly what it means. They didn't generate enough sustainable cash from their operations to fully cover the check they sent to shareholders.
So where did that extra penny per share come from? You mentioned earlier it came from that total economic return, the unrealized gains in their book value. But for an income investor, why isn't that good enough? If the total return is positive, who cares where the money came from?
That is the absolute core conflict of investing in an mREIT. Legally, a REIT is allowed to use unrealized capital gains, that is, appreciation in its book value, to fund its dividend. But for an income investor, it highlights a major structural weakness.
Right, because you want that monthly check to come from a repeatable, predictable process.
You want it to come from the interest spread they earn, month in and month out. Relying on your assets going up in value it's just not sustainable. It's volatile. What happens if the MBS market has a bad quarter? The book value gains evaporate, and suddenly that source of funding for the dividend is gone. It's a clear signal that the core operation is under a lot of pressure.
And we see that pressure in the margins, too. They're getting squeezed.
Yeah. Profit margins fell year over year from over 81% down to about 72%. That tells you that even with that 91% hedge, their cost of borrowing is still uncomfortably close to what they're earning on their assets. If that spread keeps getting tighter, it's going to be very hard to consistently earn that 36 cents per share from operations alone.
Which brings us to the valuation puzzle. The stock is at $10.15, which seems kind of optimistic, given that the core income isn't even covering the dividend.
Let's look at the numbers again. The market price is $10.15, but the tangible net book value, the TNBV, was $8.28 at the end of Q3.
So investors are paying a 23% premium over what the company's assets are actually worth on paper.
Exactly. You're not buying AGNC for its current liquidation value. You are paying a significant premium based on faith. You're betting that management can keep hedging perfectly, that the Fed will cut rates just like everyone hopes, and that they can keep paying that dividend no matter what the cash flow says. That premium is a risk indicator all by itself.
And we can't talk about risk without coming back to the big one, the existential danger of that high leverage.
That D to E of 6.24 is always there, lurking in the background. It's great when things are going your way, but in a volatile environment, even one where you expect cuts, any surprise, any geopolitical shock, any change in Fed language, it will immediately amplify your losses by more than 6 times. The stock is built to be volatile. You have to accept that going in.
And lastly, what about signals from inside the company? Any insider selling or buying that we should know about?
There was one bearish signal noted in mid-November. The CFO, Bernice Bell, sold about 20,000 shares.
Which isn't a huge amount, but
It's not a market-shaking sale, no. But any selling from a chief financial officer, it can subtly affect investor confidence. It at least makes you wonder about their own internal forecast for the next quarter or two.
so we've got a company with this fantastic economic recovery, but a really serious flaw in its operational cash flow. It's trading at a big premium, and it's all sitting on a mountain of leverage. It's a real tightrope walk.
It absolutely is.
Okay, so to really understand the risk in AGNC's pure play model, we have to compare it to its main rival. How does AGNC stack up against Annaly Capital Management, ticker NALY?
This is a perfect comparison because they represent two different philosophies. AGNC, as we've said, is the pure play specialist. It's a high beta bet on one thing.
Yeah.
Agency MBS spread.
Right.
Annaly, on the other hand, is much more diversified. They're also in residential credit. But the most important difference is that they hold a large portfolio of mortgage servicing rights, or MSRs.
And MSRs are the game changer here. Why did they give Annaly a structural advantage that AGNC just doesn't have?
Because MSRs are a natural hedge against the one thing that crushes agency MBS, rising interest rates.
How does that work?
When the Fed raises rates, fewer people refinance their mortgages, right? So the company that owns the right to service that mortgage to collect the payments gets to do it for longer. The value of that right, the MSR, actually increases when rates go up.
I see. So when Annaly's main MBS portfolio is losing value because of rate hikes,
Their MSR portfolio is gaining value, which helps offset the loss. It provides this organic, built-in balance that AGNC has to try and replicate artificially with complex hedges.
and we can see this difference in their performance, can't we?
Absolutely. Over the last year, which includes the tail end of that hiking cycle, Annaly's total return was 16.6%. AGNC's was 11.2%. That diversification really helped Annaly weather the storm better. AGNC's pure focus just makes it much more volatile. It's a high beta play, plain and simple.
It's the difference between having a portfolio that automatically balances itself versus relying 100% on the skill of your risk managers to navigate the storm.
A very good way to put it.
So let's take an even wider view. Let's connect AGNC's current high leverage model back to that last era of extreme Fed intervention. quantitative easing.
Yes, looking at the history of Fed actions, especially between 2008 and 2015, gives us really important context for why mREITs behave the way they do.
There's research that suggests the Fed's actions back then actually had some unintended side effects for private investors like AGNC.
That's right. During QE, the Fed became the biggest buyer of agency MBS in the world. They were hoovering them up, and this effectively crowded out private investors. The investment opportunities from REITs just shrank because the Fed was buying all the best assets, which pushed down the potential profits.
So with profit margins getting thinner, how did companies like AGNC respond?
Well, the evidence shows that to maintain their target returns, a behavior that researchers call reaching for yield, agency mREITs did one thing. They cranked up the leverage. They significantly lowered their equity to assets ratio, which is just another way of saying they dramatically increased their debt to equity.
So the extreme leverage we see today isn't just a random choice. It's a learned response from previous periods when the Fed was distorting the market. It confirms how sensitive this model is.
It absolutely confirms the historical vulnerability.
Yeah.
And the research shows this behavior was most obvious during the tougher phases, like QE3 and the tapering period. Management was basically forced to take on more and more risk just to keep those dividends flowing.
That's a fascinating history.
And it showed a clear trade-off. They would often try to reduce their short-term liquidity risk, but it frequently came at the cost of taking on even more long-term interest rate risk. So this historical context just reinforces that AGNC's pure-play high-leverage model is fundamentally wired to magnify risk whenever central bank policy gets involved.
Okay, so we have dissected this thing from every angle. We have the dependence on the Fed, the 91% hedge, the great economic return, and then that critical shortfall in its core cash flow. So what does it all mean for someone listening right now, looking at that tempting 14+% yield? What's the takeaway?
At the end of the day, you're left with two completely opposite valuation signals, and the investor really has to decide which story they believe.
Let's start with the bull case, the really optimistic view from the discounted cash flow models.
Right. So if you run a DCF model, you can come up with these huge intrinsic value estimates. Some as high as $22.52 a share.
Which is more than double the current price.
More than double. But, and this is a huge but, that number relies on some massive assumptions. It assumes management executes perfectly, that their hedging continues to work, and that the Fed rate cuts happen exactly as forecast, leading to a huge and sustained improvement in their profit margins.
So that's the optimistic future. What about the bearish case, which is based on today's reality?
That case focuses on a much simpler metric. Price to tangible book value. The simple fact that the stock at 10.15 is trading at a 23% premium to its 8.28 book value. That tells you the market has already priced in a lot of that good news.
The recovery is already baked into the price.
Exactly. The risks, especially that dividend coverage issue, are real. And investors are paying a premium for a promise, not for a currently sustainable stream of operational cash.
So given that divide, how should different kinds of investors think about this? What's the final verdict from our sources?
We really have two distinct takeaways, and it all depends on your tolerance for risk.
Okay, first, let's talk to the pure income investor. The person who might rely on that 12-cent monthly check to pay the bills.
For that group, the recommendation has to be caution, a hold. That Q3 dividend coverage failure, the 35 cents of income versus 36 cents of payout, that is a major, undeniable risk signal. An income investor needs to see that the operation is self-funding. They should probably wait for the Q4 results to see if that net spread income gets convincingly and consistently back above that 36-cent line.
Because relying on the market to boost your book value every quarter is not a retirement strategy.
It is absolutely not.
Okay, second group, the total return investor. Someone with a higher risk tolerance, who's okay with volatility if it means getting that high yield plus some potential upside in the stock price.
For that investor, you could make a case for a buy or an overweight position, but you have to know what you're buying. It is a bet. It's a bet on management's skill with those hedges, and it's a bet that the Fed rate cuts are coming soon enough and fast enough to keep that 10.6% economic return trend going.
You're betting the macro tide will lift your boat higher than the operational leak can sink it.
That's a perfect analogy. It is a high beta play. It will react to every single whisper from the Federal Reserve.
So this deep dive really shows that AGNC is. It's a complex, highly leveraged financial machine. It is not a simple, safe, high-yield stock. That double-digit yield is incredibly tempting, but what you're really doing is placing a leverage bet on two things: the future path of the Federal Reserve, and the continued skill of management to navigate an incredibly risky environment.
Absolutely. It's an investment that demands you keep your eye on the ball. You have to constantly monitor that net interest spread and that tangible book value. For AGNC, the whole story is in that spread.
Well, thank you for joining us for this very deep dive into AGNC Investment Core. It was a fascinating look at the high-stakes world of M and that very delicate balancing act.
It was. I hope this analysis has given everyone a clear, balanced view of the company's strengths, its very real risks, and the conflicting signals we're seeing as of November 2025.
And if there's a company you want to know more about, please leave a comment. We'll be back soon with another deep dive.